Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Well, now that the Cliff drama has ended, the big question is, what's next? And that's what we're going to try to find out with senior stock strategist Kevin Cook, stock strategist Todd Bunton, and ETF strategist Eric Dutram in this conversation. And Eric, let's start with you. The deal drama is over. What did the deal actually fix? You say not much.
Not much, but I'm still pretty surprised that we even got a deal. I'm almost kind of shocked that the Republicans and the Democrats, found some common ground after all the bickering they've done for, really the past couple of years here. So I think it's pretty incredible that a deal even came to pass. But unfortunately, it's going to be tax increases for about, I think it was 77% of Americans, and might see a little bit of uncertainty here once we approach the debt ceiling debate.
Well, the 77% is only because of the payroll taxes.
Right.
Sure.
But it's still an increase, though, for most of the people out there.
They had to leave something out there. There were a lot of moving parts.
So we got this Cliff drama done with now, but the next, at least mini Cliff, I think, is the debt ceiling, right?
I think that's even going to be more of an issue than what we saw with the fiscal cliff. What about you, Todd?
Todd, you say that the deal that we just saw just assuages investors' fears.
Yeah, and you can see that today. We're rallying here on Wednesday, January 2nd. Stocks are soaring higher. Obviously, it just takes some fear off the table that that we're going to fall off a cliff, that we're going to enter a recession. Yes, the higher taxes will be a drag on Q1 GDP, but only about 1% from what I've seen.
But is the debt ceiling for the market an even bigger fear for January?
I don't think so. I think the fiscal cliff was, because I think lawmakers some at least, were willing to go over the cliff because it wasn't really a cliff. It was more of a drag on GDP, a slow drag.
But I mean, Todd, we would only see, if we even went over the cliff, it'd only be 3 percentage point increase in taxes. And if we go over the debt ceiling, the U.S. defaults. And I think that's much bigger of a problem.
But lawmakers know that, so I don't think they will let the debt ceiling expire.
Kevin, what do you think?
Can we talk about the rally that's been going on the past 2 days?
Well, we'll get to that. What about this debt ceiling issue for the market?
It'll wait, right? The focus this month is going to be on earnings season.
Okay.
Beginning, and we know the debt ceiling debate is coming. The key takeaway, though, from what happened in the past 4 or 5 days is that Congress actually functioned, right? And a week ago, I wrote in my commentary to my Market Timer subscribers, the rally that will come from Congress functioning will dwarf any sell-off from the dysfunction we've come to expect. And that's exactly what happened. There was not a lot of fear in the market. Yeah, there was some put buying, and that's why you saw the VIX over 20. But big investors were on vacation the past couple of weeks. They weren't selling. The dividend tax selling, the tax gain selling was mostly done, and they were waiting for this to get over. Any cliff solution isn't pretty. We knew it wouldn't be pretty. But the market told you on Monday, even before Obama came up to speak and said, hey, we might be appearing close to a deal, the market said, we're going higher. This is almost over. We just need it to be over. And serious large investors, they have pent-up demand.
So against that backdrop, you're saying that the bulls are going to own January.
Yeah, and I mean, it's clearly happening right now. This rally is significant today. It's not just short covering. I think it speaks for what we're going to see here now for a good part of the year. Now, we're going to have a hiccup with the debt ceiling. January, this coming earnings season is going to bring the revisions and outlooks that we look forward to.
Right. But I think that's going to disappoint this quarter. If you look at third quarter earnings season, it was the worst on record since the Great Recession ended. And if you still look, 2013 estimates are way too high. People, at least here at Zacks, we know that those are going to come down. Outlooks are probably going to be pretty tepid. And that, I don't think, speaks.
But I see investors buying industrial stocks, looking forward, and buying materials and technology, and that tells me something positive.
Well, my friend Eric down there says that the upward market trend for January is not going to be intact because of the earnings.
Because of the earnings and all the debt ceiling stuff that I think will start to impact the market in the later half of the month. I do kind of agree with Kevin. We might see some pushback into materials, industrials, because these haven't really been doing as well. And I'm not so sure about tech. I know Kevin's a big Apple guy, but we'll see.
It's beaten down. It's an opportunity for a sector to rebound. But industrials have been surprisingly leading in the past month here.
So both you and Eric bring up a good point, and that's Q4 earnings that we're going to be in as far as earnings season is concerned. Is that going to be a drawdown here for the market? Is earnings season going to be negative, not so impressive?
I say negative. Like I was saying earlier, the trend, if you look at the recent trend in earnings, it's not good. Last earnings season, I think only 38% of companies beat on the top line, beat the Zacks consensus estimate on the top line. That usually it's 66%, so terrible earnings season. Like I said, earnings estimates for 2013 are still pretty rosy. I think management outlook, a lot of management's going to give outlook for the full year. It's going to scare some investors, and when you see earnings estimates start to fall, you see stock prices start to fall as well.
Kevin, what do you say?
Yeah, so February is going to have some fireworks with the debt ceiling and with actual earnings and actual corporate outlooks. But I think you're going to see a couple of strong weeks here of the market adjusting to, there was sort of a buyer strike, and now, hey, we need them because the economy is not going off the cliff, and we're threatening new highs here. So if this market technically gets a thrust above 1450, 1460, you're going to see 1,500 pretty quick in the first quarter.
Do you have a floor price for yourself?
I said last week that you really want to buy this market at 1375. You didn't even get a chance. The S&P futures would dip down to 1380 and right back up, and that shows lack of sellers and buyers just waiting in the wings.
Okay, thanks for that. You can be sure that they're going to be keeping their eye on what's going on, and we'll let you know what they think as soon as they think it. In the meantime, they have the first top picks of the year, and that's in our next segment.